Hi, this is Mark Carrington from mybitcoinprofits.com. In this video I'm going to go through the steps that I follow in finding opportunities in a particular sector. The example area is I'm going to do one I did yesterday in the oil sector. First of all, where does the idea come from? The idea came from Real Vision, think tank service which I subscribe to. It's a paid service. And they've done a review of market sectors, and one of the opportunity areas they've identified is oil. Energy in focus, the rally might have a ways to go. The crude market today is benefiting from several tailwinds. The question is which sectors in the crude market do you go for? So they produced this chart. It can be a little bit hard to read, but I'll identify the pieces for you. The view is the red line here is the oil price itself. So investing in long oil futures is the trade is already played out. The integrated oil providers, so these are the large providers, which is the yellow line, and the oil producers, which is the blue line, have already broken out and they are now above 100. So they're performing positively in the year to date. This is 1 year. The two sectors that are underperforming relative to 1 year ago are the blue line, or the purple line, which is the oil and gas services suppliers, and the white line, which is the what are called MLPs, the midstream limited partners. And that's where they've identified that's the opportunity area that they suggest looking at. Now, I'm invested in this sector. I'm invested in this sector, but I am underinvested in the midstream limited partners sector. So let's go through what I actually do. The first thing I like to do is I like to look at the big charts, and just to put a few things onto the chart. So I'm going to start with this one here, and let's just talk about some of the things I am invested in. The chart here is a weekly chart, and it goes back very deliberately to include the oil price peak from 2014, and it's Exxon Mobil. And I'm going to put a few other comparators on here. So we'll put, and one could have chosen Chevron or something like that, or Royal Dutch Shell. There's an ETF that tracks oil producers, which is called XOP, and I'm going to put in the oil services companies as well. There's an ETF that tracks oil service providers, which is OIH. And let's see how those look. Well, so certainly the chart then shows that the integrated producers, so this is ExxonMobil, have outperformed since the peak. I'm going to roll this back a little bit so we actually include the peak. So we can see the integrated oil provider, like an ExxonMobil, has outperformed. And if we just want to check that, we'll put in Chevron. Which is CVX, and we'll see that Chevron has actually done a little bit better than ExxonMobil, but the shape of the curve is the same. So we'll take that out, and then we'll see that XOP, so this includes large producers and small producers. It's an equal weighted fund, so there's no bias in the size of the corporations in the fund. It basically has performed in line with the oil services providers, and that's why I've been invested in both of these, is to close this gap. And the gap there is, it's minus 40 to minus 19, so it's a 20 percentage point gap. So we're going to come back to that chart to show that the premise that Real Vision are working on seems to have an opportunity. The question is how do you screen for stocks? Now, the tool I use for screening for stocks is called FinViz. Because I'm looking at US stocks, this works particularly well on US stocks. It has a screening facility here, so I've pressed the screener button here, and it's a free service. You can create an account to save your screens. I've not done that, and all I've done so far is on the descriptive tab I've highlighted oil and gas drilling and USA, and I want to pick companies of a particular size, because the first warning is that with rising interest rates, we need to be wary of small companies that might not be able to afford rising interest bills. So and so there are a number of ways here. Under market cap, I'm looking for companies that are bigger than small. So I'm going to go plus mid over $2 billion in market capitalization. And there we have a list of 8 companies. Now, what I'm particularly interested in this list is there are only 2 of these names that I actually recognize. So 3 of these names I recognize: Diamond Offshore, Patterson UTI Energy, so I've invested in that previously, and Whiting Petroleum, which I literally sold a month ago. So we can have a look at Whiting Petroleum. I'll pop at the chart, and I bought it somewhere down here and sold out up here. So it tells me that the concept is the right concept. Now, what are the next things I want to do is I want to look at the shapes of the charts and a little bit of financial information. The first thing I want to do, let's do the financial information first, because what I'm concerned about is I want to make sure that I do not land up with companies that have a high long-term debt to equity ratio. So as it happens in this list, long-term debt to equity ratio for the one that's on the top of the list is, this is listed alphabetically, is 60%. I can sort them by return on investment or return on equity. So we got CXO wasn't on the list when I did the screen yesterday. RSPP, AR. So what I did is I actually used return on investment. So AR looks like a candidate, and its debt to equity ratio is acceptable at 60%. It's a little bit high, but it's acceptable at 60%, and I suspect the 60% is one of the factors that's driving this high ROI, because they're using cheaper money to fund their business. The next thing I want to do is have a look at the shapes of charts. The charts, then, I'm looking for things that are showing signs of life, that have broken out. So there's the AR chart. This one is already gone. RSPP is already gone. CXO, Diamond, this is tracking sideways. This one is tracking sideways. P10 has dropped and has recovered. The Whiting Petroleum has raced ahead, and I was part of that race. And then this business called TEL has bottomed out and is recovered, and then is doing a retrace at the moment. So that's the first level. That was looking at oil and gas drilling. Now I also want to look at pipelines. Again, no change here, looking at the mids. I'm going to go back to the financials. We'll do the overview first. Quite a long list now. Quite a long list of companies. And we'll go to financials. And what I want to do is I'm going to sort these by the ones with the lowest debt to equity ratio. And then I want to look at the shapes of charts. So we've got CDEV, ENBL, EQM, QP, DCP, SCP, there's a number in here, BWP, SHLX, and they all have, so the debt to equity ratios are, SHLX is starting to get a little bit high. Now to charts, shapes of charts, and these are the charts that I quite like. This shape of chart is what I like. So CDEV becomes a candidate. ENBL becomes a candidate. EQM has not, it's collapsed again, so there's something wrong in the company. QEP is already gone. DCP is a possibility. SCP, there's something happened here. It's probably just announced some bad earnings. WB's PZ is the right sort of shape. This is the right sort of shape. BWP, SHLX, right sort of shape. Question then is, this has got the right sort of shape. BPL, TEP. Question then is, how do you actually choose? Well, what I went through, I looked at CDEV, ENBL, BWP, SHLX. I don't know which of those are. So we go CDEV. I like the shape of the chart. The price is modest. We could go between 18 and 22, so there's a 25% improvement there to reach the highs. We go to ENBL, we're going from 14 to 16, so there's a 10, 12, 15% improvement to get to the highs. The next one I looked at was BWP, and the last one is SHLX. The important piece then is how do you then go down one level to see how well any one of these will survive rising interest rates. So to do that, I am going to go to finance.yahoo.com. And I'm going to look specifically at financial data. So there's CDEV's financial data, and I'm looking at the income statement, and the key number I'm looking for is this one. I'm looking at the ratio between interest expense and operating income. So that's a ratio of 5. So their interest expense is covered 20 times by operating income in the last financial period. So if I just work through the list that I produced, I had CDEV, ENBL, interest expense 120, operating income 528, so that's 4 times coverage. We'll go to DCP. Interest expense 289, operating income 222, so they are not covering their interest expenses with their operating income, which means that revenues have to rise dramatically for them to be able to continue to cover the interest expense. So DCP went off the list. So I worked my way through that list and picked 4: CDEV, ENBL, BWP, and SHLX. And the last thing I just want to do is put them relatives on the chart and just see how they stack up. So I'll leave the ExxonMobil chart up there, and then we will see where we stand. AR, which was an oil producer, and then we'll put in the pipeline companies. CDEV, ENBL, BWP, and SHLX. And there we go, compared to ExxonMobil as a benchmark. We'll find that 1, 2, 3, 4 of them have underperformed since the 2014 peak, and one has actually outperformed, but it's only recently listed, so it's not a that was CDEV, so I will take it off there. So basically what we're looking at, particularly AR, I was interested in as the oil producer, is at minus 66. If it closes half to that gap, that's a 33% performance improvement possibility. So that's the process they went through. So a quick reminder: get an idea of a sector that has opportunity, run through the screening to look at shapes of charts, to look at the overview of their financials and then step into the detail of the financials to understand the risk from rising interest rates. I appreciate your time and happy investing.